Imagine for a moment that you receive a call. An opportunity of a lifetime requires you to leave the country tomorrow. You'll be gone for 10 years, completely off the grid. No internet, no phone calls, no way to check the stock market or contact your broker. You have just a few hours to arrange your financial affairs. All of your savings, your family's future, must be consolidated into a portfolio of stocks that you cannot touch, cannot trade, cannot even think about for a solid decade. What do? Which companies make the cut? This isn't a parlor game. This is perhaps the most powerful question in all of investing, because it cuts through the noise of quarterly earnings, market sentiment, and daily headlines. It forces you to confront the one variable that truly underpins all successful long-term investing: absolute, unshakable trust. It's a test that Warren Buffett has used not just for the stocks he buys, but for the very architecture of his entire corporate empire, Berkshire Hathaway. He has built the most successful conglomerate in history on a principle so simple it seems almost naive, yet so powerful it has created hundreds of billions of dollars in value. It's a principle of extreme decentralization, a system built not on complex controls and oversight, but on the bedrock of absolute trust in his managers. When applied to your own stock picking, this principle becomes a final, clarifying filter. It means only investing in a company when you trust its management team so completely that you feel no anxiety handing them your capital and walking away for 10 years. This isn't just about finding competent executives. It's about finding people you believe in on a fundamental level, people whose integrity and judgment you would stake your family's future on. Adopting this framework prevents the most costly mistake in the market: buying into businesses where you harbor a lingering, corrosive doubt about the people in charge. That small seed of uncertainty is what blossoms into full-blown panic during the inevitable market downturns, compelling you to sell at the worst possible moment. By embracing this model, you will learn to use absolute trust as your ultimate investment criterion. You will build a portfolio of companies run by people you genuinely admire, creating the psychological fortitude necessary to truly buy and hold, to let the miracle of compounding work its magic in peace. This is the key to transforming your portfolio from a source of stress into a source of serene, growing wealth. It's the key to finding those true, sleep-well-at-night stocks and achieving a state of genuine financial peace. Our journey begins not in the frantic trading pits of Wall Street, but in the quiet, unassuming city of Omaha, Nebraska. It is here that we can truly understand the foundation of Warren Buffett's philosophy, a system that looks unlike any other major corporation on earth. This is the Berkshire Blueprint, a sprawling empire built not on layers of management and bureaucracy, but on a delicate and immensely strong web of unbreakable trust. To see this principle in its purest, most potent form, we must travel back in time and meet a woman who was a force of nature, a retail titan, who couldn't read or write English fluently, but could outsell and outmaneuver any competitor who dared cross her path. Her name was Rose Blumkin, but to the world, she was simply Mrs. B. In 1983, Buffett was looking to acquire great businesses run by great people. He heard about the Nebraska Furniture Mart, a single store in Omaha that did hundreds of millions of dollars in sales, dwarfing its competition. The business was the life's work of Mrs. B, a Russian immigrant who had fled persecution and arrived in America with nothing but a tag around her neck that read Fort Dodge, Iowa. She had saved $2,000 to start a furniture business in a basement in 1937, with a simple motto: sell cheap and tell the truth. For nearly half a century she worked 7 days a week, a whirlwind of energy, bargaining with suppliers, managing inventory, and personally closing sales on the showroom floor, often in her signature golf cart. When Buffett approached her to buy the business, the negotiation was as unconventional as Mrs. B herself. There were no teams of investment bankers, no legions of lawyers performing months of due diligence. There was just Warren and Mrs. B. He asked her what the business was worth. She gave him a number. He looked at her financials, saw the incredible success she had built, and he agreed. The deal for 90% of the Nebraska Furniture Mart was sealed for roughly $55 million, with a 1.25-page contract. Buffett never even took an audit. Why? because he wasn't just buying a collection of assets and inventory, he was buying into Mrs. B. He was investing in her character, her drive, her unimpeachable integrity. He trusted her completely. The contract stipulated that she, her son, and her grandsons would continue to run the business with zero interference from Berkshire's headquarters. Buffett's only job, as he saw it, was to provide capital when needed and get out of the way. This was the epitome of his management philosophy. He believed that great managers are artists, and you don't tell Picasso how to paint. You give him a canvas and let him create his masterpiece. For several years, the partnership was a spectacular success. The business continued to grow, and Mrs. B continued to reign as its matriarch. But then, a conflict arose. At age 95, her grandsons, who were helping to run the day-to-day operations, felt she was getting too old to continue making major purchasing decisions. They tried to ease her out of her role, to put her in a ceremonial position. Mrs. B, a woman who had wrestled a business into existence from nothing, would have none of it. In a fit of righteous fury, at the age of 95, she quit. Most executives in Buffett's position would have panicked. The legendary founder, the heart and soul of their $55 million investment, had just walked out. But Buffett remained calm. He trusted his managers, and that now included the Blumkin grandsons. He let them run the business. But Mrs. B wasn't finished. A few months later, at age 96, she took her own capital and opened a new, competing furniture store right across the street from the one she had sold to Buffett. It was called Mrs. B's Clearance and Factory Outlet. She started underselling her old store, and customers, loyal to her for decades, flocked to her new location. It was an immediate, roaring success. The national business press delighted in the story. A 96-year-old grandmother was running circles around the world's most famous investor. Buffett, rather than being angry or litigious, was amused and deeply impressed. He saw this not as a betrayal, but as a confirmation of everything he believed about her. She was a creator, a builder, a force that could not be contained. He continued to send her a dozen roses every year on her birthday. After a few years, recognizing the absurdity of competing with his own partner, Buffett did the only logical thing. He went to Mrs. B and bought her new business, merging it back into the Nebraska Furniture Mart. And he did it without forcing her to sign a non-compete agreement, because he knew it would be pointless. As he famously said, he'd rather wrestle a grizzly bear. Mrs. B continued working until she was 103 years old. This entire saga is the foundational anecdote of the Berkshire system. It reveals a deep psychological truth about human motivation. The principle at play here is a powerful combination of what psychologists call psychological ownership and the Pygmalion effect. Psychological ownership is the feeling that something is mine. It's not about legal title, it's an emotional state. When we feel psychological ownership over our work, we pour our hearts and souls into it. We care for it, protect it, and nurture it as if it were our own child. Micromanagement is the enemy of psychological ownership. When a manager is constantly looking over your shoulder, questioning your decisions, and demanding endless reports, it sends a clear message. This is not yours. You are just a hired hand. I don't trust you. This breeds resentment, compliance instead of commitment, and mediocrity. Buffett's approach does the exact opposite. By handing over the keys and saying, "Run this business as if it were your own, call me only if you need something," he instills the most profound sense of psychological ownership possible. He makes his managers feel like partners, like founders, even after they've sold their company. This is directly linked to the Pygmalion effect, named after the Greek myth of a sculptor who fell in love with a statue he carved, which was then brought to life. In business, this effect describes the phenomenon where our expectations of others can influence their performance. If you treat someone as if they are brilliant, responsible, and trustworthy, they are far more likely to behave in that way. It becomes a self-fulfilling prophecy. Buffett's absolute trust is the ultimate expression of the Pygmalion effect. He doesn't just hope his managers are great, He expects them to be great, and in doing so, he empowers them to achieve it. This is not a soft, feel-good management tactic. It is a hard-nosed, cerebral strategy for unlocking human potential. On a neurological level, trust and autonomy are incredibly powerful. When we feel trusted, our brains release oxytocin, a neurochemical that promotes social bonding and reduces fear. When we are given autonomy, our brains produce more dopamine, the neurotransmitter associated with motivation and reward. Buffett's hands-off system essentially creates the optimal neurochemical environment for high performance. It replaces the cortisol-fueled anxiety of a typical corporate job with an oxytocin and dopamine cocktail of trust and empowerment. So how can we translate this into a practical mental model for our own lives, whether as an investor, an entrepreneur, or a manager? The blueprint is something Buffett calls the postcard test. He has said that the instructions he gives to the CEOs of Berkshire's operating companies should be able to fit on a postcard. They are typically something simple like, run your business as you see fit. Send us the cash you don't need. Call us if you have a problem. This model forces a radical focus on what truly matters. To apply it, you must first distill the mission down to its absolute essence. If you are a manager, what is the single most important objective for your team? Not the 10 KPIs, not the quarterly goals, but the one overarching purpose. Define it with absolute clarity. For the Nebraska Furniture Mart, it was always, sell cheap and tell the truth. Everything else was secondary. Second, you must hire for character above all else. The postcard test is impossible without the right people. Buffett spends an immense amount of time judging the character of the people he brings into the Berkshire family. He is looking for passion, integrity, and an independent spirit. You cannot delegate absolute trust to someone who is merely competent. You must delegate it to someone whose values align with the mission. Third, you must establish a reporting system based on confirmation, not interrogation. Berkshire's headquarters is famously tiny, with only a couple dozen employees overseeing a $500 billion enterprise. They don't have teams of analysts poring over every decision. The operating companies send in their financial results. As long as those results are consistent with the company's long-term strategy and there are no signs of trouble, that's enough. The communication is about confirming that the trust is well placed, not about constantly questioning it. For an investor, applying the postcard test means looking for companies where the mission is clear and the management can operate without constant interference. It's about finding a business so fundamentally sound and a management team so clearly aligned with shareholders that you could write your investment thesis on a postcard and feel confident in it for a decade. Now, let's explore the opposite approach, the path of the 99%. This is the world of corporate micromanagement and the obsession with quarterly earnings. In the typical large corporation, trust is a scarce commodity. Power is centralized, decisions are made by committees, and innovation is stifled by bureaucracy. A brilliant, entrepreneurial manager in this environment is not seen as an asset, but as a threat. Their autonomy is systematically stripped away. Their days are filled with endless meetings to align stakeholders, PowerPoint presentations to justify every decision, and a constant pressure to hit short-term targets, even at the expense of long-term value. Imagine a talented product manager who has a brilliant idea for a new product. In a Berkshire-like environment, she would be given the capital and the freedom to pursue it. In the antithesis environment, she first has to create a 50-page proposal. Then she has to present it to a steering committee, which demands a detailed 5-year financial projection for a product that doesn't even exist yet. The finance department insists on cutting the budget, marketing demands changes to appeal to a focus group, and the legal team flags a dozen potential risks. After 6 months of this soul-crushing process, the original bold idea has been watered down into a safe, mediocre product that excites no one. The manager, once passionate and driven, becomes disengaged and cynical. She learns that the way to succeed in this company is not to build great things, but to navigate the bureaucracy and manage perceptions. This is the world that Buffett's system was designed to reject. He knows that this culture doesn't just create bad products, it repels the best people. The truly talented, the Mrs. B's of the world, will not tolerate it. They will either leave to start their own companies or they will never join in the first place. The direct financial connection between Buffett's trust-based system and Berkshire's success is staggering. Firstly, it creates a unique and powerful source of deal flow. Many of the best businesses in the world are family-owned. The founders have spent their lives building the company, and it's part of their identity. When it comes time to sell, they are often horrified by the prospect of turning their life's work over to a private equity firm that will likely load it with debt, fire longtime employees, and flip it for a quick profit in a few years. Berkshire offers a permanent home. Buffett offers them a promise. Your business will continue to be run by the people who know it best. Your culture will be preserved, and your legacy will be protected. This allows him to buy wonderful businesses that are not for sale to anyone else, often at prices far more reasonable than what would be paid in a competitive auction. This is a massive unquantifiable advantage. Secondly, the model creates extreme operational efficiency. Berkshire's corporate overhead is a rounding error compared to its revenues. There is no bloated central staff of strategists, planners, or synergy experts. The value is created at the operating companies, not at headquarters. This structure saves billions of dollars over the years, all of which can be reinvested into compounding shareholder wealth. Finally, and most importantly, the system of trust unlocks the full, long-term potential of the businesses it acquires. A manager who is free from the tyranny of quarterly earnings can make decisions that will pay off in 5 or 10 years, not just in the next 90 days. They can invest heavily in research and development, build deeper customer relationships, and create a sustainable competitive advantage. The financial result of this blueprint is clear in Berkshire Hathaway's decades-long outperformance of the S&P 500. It is a testament to the fact that trust is not a soft skill. It is the ultimate financial asset. The system Buffett built is a machine designed to attract, empower, and retain the best managers in the world, and then let them do what they do best. It began with a handshake deal with a 90-year-old retail legend, and it has grown into the most respected and successful investment vehicle in history. Having understood the internal architecture of Berkshire, built on a foundation of absolute trust in its managers, we can now pivot to the external application of this principle. How does Warren Buffett, as an investor in public companies, identify management teams that are worthy of this same level of trust? This is not about blind faith. It is a rigorous, evidence-based assessment of character and competence. It's about finding captains for your capital who are not just skilled navigators but are fundamentally shareholder-friendly. They must be partners in wealth creation, not simply hired hands extracting value for themselves. This is the trust litmus test. To explore this, we turn to the story of another manager whom Buffett admired perhaps more than any other, Tom Murphy, the CEO of Capital Cities/ABC. The story of Buffett's investment and deep respect for Murphy is a masterclass in identifying superior management quality. Buffett first invested in Capital Cities in the late 1970s, but his major involvement came in 1985 when Murphy decided to do something audacious. He wanted to acquire ABC, a company more than 3 times its size. To finance this massive $17 billion deal, Murphy needed capital and a stamp of approval. He turned to Buffett. Buffett agreed to provide a significant chunk of the financing in exchange for a large stake in the combined company. His decision wasn't based on complex spreadsheets or industry forecasts. It was based almost entirely on his unwavering belief in Tom Murphy and his longtime partner, Dan Burke. For years, Buffett had watched them operate Capital Cities with a discipline and rationality that was breathtaking. Murphy was the polar opposite of the slick, self-promoting CEOs of his era. He was understated, humble, and famously frugal. Stories of his thrift were legendary. He forbade company jets, insisted his executives fly coach, and often answered his own phone. At one point, he sent out a memo telling employees to reuse paperclips. This wasn't about being cheap. It was about creating a culture of ownership. He believed that every dollar spent was a dollar that belonged to the shareholders, and it should be treated with the utmost respect. But his true genius lay in his mastery of capital allocation. Murphy understood that the primary job of a CEO is not to run the day-to-day operations, but to decide how to deploy the company's cash. Should it be reinvested in the business? Used to acquire other businesses? Returned to shareholders through dividends or buybacks? Murphy and Burke made these decisions with a stunning lack of ego. They only made acquisitions when the price was right and the fit was perfect. They consistently bought back their own stock when it was trading at a discount to its intrinsic value, a simple but powerful way to increase the ownership stake of the remaining shareholders. When they completed the ABC acquisition, they brought this same discipline to the much larger and notoriously bloated network. They ruthlessly cut costs, sold off non-core assets, and focused the business on its most profitable operations. Their communication with shareholders was a model of clarity. In their annual reports, they spoke in plain English, openly admitted their mistakes, and laid out their strategy with honesty and transparency. Reading a capital city's annual report was like having a candid conversation with a trusted partner. Buffett's trust in Murphy was so complete that he considered his investment in capital cities/ABC to be largely a passive one. He knew that Tom Murphy would wake up every morning thinking about how to increase the long-term value of the business for its owners. He didn't need to be watched. He had passed the litmus test. The psychological principle underpinning this entire evaluation is the agency problem. This is one of the most fundamental concepts in finance and economics. In any situation where one party, the agent, in this case the CEO, is supposed to act in the best interest of another party, the principal, the shareholders, there is an inherent conflict of interest. The CEO might be more interested in increasing their own salary, building a larger empire, or enjoying lavish corporate perks than in maximizing shareholder returns. The vast majority of corporate governance structures, boards of directors, compensation committees, shareholder votes, are designed to mitigate this agency problem. But Buffett knows that these are imperfect solutions. The ultimate solution is to find an agent who doesn't think like an agent at all, but who has the owner mentality. An owner-manager internalizes the goals of the shareholders. They feel the pain of a dollar wasted as if it were their own. They are driven by an internal desire to build lasting value, not by external incentives. Identifying this mentality requires looking for specific behavioral traits that counteract common cognitive biases that afflict most CEOs. One is the, quote, empire-building bias, the desire to preside over the largest possible enterprise, even if it means making value-destructive acquisitions. Tom Murphy was immune to this. He was perfectly happy to run a smaller, more profitable company than a larger, mediocre one. Another is the endowment effect, where managers overvalue their own projects and divisions and are reluctant to shut them down even when they are failing. Murphy and Burke were ruthless in culling underperforming assets, demonstrating a supreme rationality. By finding a manager who has conquered these biases, you find someone who has solved the agency problem at its root. So how can a regular investor apply this and conduct their own trust litmus test? The blueprint is a mental model I call the shareholder letter scan. The CEO's annual letter to shareholders is the single most important document for judging management quality and CEO integrity. Most investors ignore it or give it a cursory glance. But if you know what to look for, it is a window into the mind of the person leading the company. Here is a step-by-step guide to performing the scan. First, look for candor. Does the CEO openly and specifically discuss the company's mistakes from the past year? A manager who blames all failures on external factors like the economy or competition is not taking ownership. A manager who says, "We made a mistake in this area, here's what we learned, and here's how we're fixing it," is demonstrating integrity and a commitment to learning. Tom Murphy's letters were famous for this. Second, check for clarity of language. Is the letter written in simple, direct English, or is it filled with corporate jargon, buzzwords, and vague platitudes like leveraging synergies or optimizing our strategic footprint? Jargon is often used to obscure a lack of clear thinking. A CEO who cannot explain their business in simple terms probably doesn't understand it very well. Buffett himself is a master of this, and he looks for it in others. Third, analyze the discussion of capital allocation. This is the most crucial part. Does the CEO explain times why they are making certain capital allocation decisions? If they are buying back stock, do they explain that they believe the stock is undervalued? If they are making an acquisition, do they lay out the financial rationale and the metrics by which it should be judged a success or failure in the future? A CEO who treats capital allocation as an afterthought is likely destroying value. A CEO who discusses it with the precision and care of a master investor is a true partner. Fourth, look for consistency in metrics. Do they highlight the same performance indicators year after year, in good times and bad? Or do they change the goalposts, emphasizing revenue growth one year and adjusted EBITDA the next, always choosing the metric that makes them look best? Consistent, honest reporting is a hallmark of trustworthy management. Finally, what is the overall tone? Does it sound like a sales pitch, full of hype and promises? Or does it sound like a sober, realistic report from one partner to another? The goal is to find a letter that informs rather than persuades. By systematically applying this shareholder letter scan, you can move beyond the numbers and begin to form a clear picture of the character and mindset of the management team. You can start to separate the true owner-operators from the promoters. And this brings us to the antithesis, the path of the 99% of investors who are seduced by the promoter CEO. The promoter CEO is a master of narrative. They are charismatic, articulate, and often appear on the covers of magazines. They are brilliant at selling a vision of the future, a story of disruptive technology or world-changing innovation. They are focused, above all else, on the company's stock price. Their conversations are littered with references to shareholder value, but their actions often reveal a different priority: their own enrichment and fame. The warning signs of a promoter CEO are clear if you know to look for them. They engage in excessive stock promotion, spending more time on television interviews and investor conferences than on the actual business. They make grandiose promises that are consistently unmet. Their acquisitions are often transformative and strategic, but come at enormous premiums and are justified with vague synergies that never materialize. Their annual letters are marketing documents full of glossy photos and buzzwords, but devoid of substance. The average investor is highly susceptible to the promoter CEO. They buy the story without scrutinizing the storyteller. They get caught up in the excitement and the momentum, ignoring the fundamentals of the business and the track record of the management. This is a path that almost always ends in disaster. When the growth story inevitably falters, the stock price collapses, and the promoter CEO often walks away with a massive golden parachute, leaving shareholders holding the bag. The direct financial connection between finding a Tom Murphy and avoiding a promoter CEO is the difference between compounding wealth and incinerating it. Let's imagine two companies over a 10-year period, both starting with a book value of $1 billion. Company A is run by a Murphy-esque CEO with a focus on rational capital allocation and CEO integrity. Company B is run by a promoter CEO. In year one, both companies earn $100 million. The CEO of Company A, believing his stock is undervalued, uses $50 million to buy back shares and reinvests the other $50 million in his highest return business unit. The CEO of Company B, wanting to make a splash, issues new shares to acquire a trendy but unprofitable competitor for $500 million, promising massive future growth. Over the next decade, the CEO of Company A continues this disciplined approach. He makes small, smart acquisitions, consistently repurchases shares when they are cheap, and prunes underperforming divisions. The business grows steadily, and the share count shrinks. The per-share value of the business compounds at an impressive rate. The CEO of Company B continues his empire building. He makes more dilutive acquisitions, takes on huge amounts of debt, and focuses on top-line revenue growth at any cost. The company gets much larger, but it becomes less and less profitable. the return on equity plummets. After 10 years, Company A might have a book value of $3 billion, but because of the share buybacks, its per-share book value has increased tenfold. Its stock price has followed suit. Company B might have grown its revenue to $5 billion, but its book value is still only $1 billion, and its share count has doubled. Its stock price is flat, or, more likely, has collapsed under the weight of its debt and poor profitability. This is not a theoretical exercise. This is the story that is played out time and time again in the stock market. The quality and character of management is not a soft, secondary factor. It is the single most important driver of long-term value. By learning to apply the trust litmus test, by seeking out the Tom Murphys of the world and rigorously avoiding the promoters, you are not just improving your stock-picking skills. You are fundamentally altering your long-term financial trajectory. You are choosing the path of patient, rational compounding over the path of speculative hope. Investing without a deep, foundational trust in the people running your companies is like setting sail in a ship you suspect has a leaky hull. In calm seas you might feel fine, but you live with a persistent, low-grade anxiety. And when the storm inevitably hits, that anxiety will erupt into pure terror. This is the psychology of doubt, and it is the primary reason why most investors betray their own best interests, buying high in a state of euphoria and selling low in a state of panic. To understand how to conquer this, we must examine a moment of extreme market panic and see how Warren Buffett's trust in a business and its core integrity allowed him to act with supreme rationality when everyone else was consumed by fear. Our story takes place in 1963. It's known as the salad oil scandal. A company in New Jersey called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, had perpetrated one of the greatest financial frauds in history. DeAngelis had discovered a loophole in the warehousing system. He would borrow massive amounts of money using his inventory of salad oil as collateral. But the inventory was a phantom. His storage tanks were mostly filled with seawater, with only a thin layer of oil floating on top to fool the inspectors. He had created billions of pounds of ghost oil on paper, borrowing against it from dozens of Wall Street's most respected firms. One of his biggest creditors was American Express, through its warehousing subsidiary. When the fraud was uncovered, Allied Crude immediately went bankrupt. Wall Street was plunged into chaos. The central question was whether American Express itself would be held liable for the losses on the fraudulent warehouse receipts. The market's verdict was swift and brutal. Panic set in. Investors dumped their American Express shares, convinced the company was facing ruinous liabilities that would wipe out its equity. The stock price was cut in half in a matter of weeks. This was the moment of maximum fear, the point where the psychology of doubt takes over. The narrative was simple and terrifying. American Express is going to go bankrupt. But Warren Buffett, then a young, relatively unknown fund manager, refused to succumb to the panic. He didn't just look at the headlines or the falling stock price. He went to work. He knew that the temporary liability from the scandal was one thing, but the real value of American Express lay in its two core businesses: the travelers, checks, and the credit card. The value of these businesses was based entirely on trust. If people stopped trusting the American Express brand, the company was indeed worthless. So Buffett became a detective. He visited restaurants and asked waiters if customers were still using their American Express cards. He went to banks and asked tellers if they were still selling the travelers' checks. He talked to merchants and travel agents. Everywhere he went, the answer was the same. Yes, people were a little worried, but they hadn't lost faith. The brand was too strong. They still trusted the iconic blue box. He concluded that the company's fundamental competitive advantage, its moat of trust with consumers, was intact. He realized that the market, in its panic, was pricing the company for bankruptcy, while the underlying reality was that its core business was largely unaffected. So while others were selling in a frenzy, Buffett was buying with both hands. He invested 40% of his partnership's capital into American Express stock. It became his single largest investment, and it was a spectacular success. The company weathered the scandal, the stock price recovered and then soared, and Buffett made a fortune for his partners. This story is the perfect illustration of how to behave when the psychology of doubt takes hold of the market. The key psychological principle at play here is loss aversion, a concept pioneered by the Nobel laureates Daniel Kahneman and Amos Tversky. Their research demonstrated that for human beings, the psychological pain of a loss is roughly twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. This is a fundamental feature of our mental wiring, a survival mechanism from our evolutionary past, where losing your food supply was a much bigger deal than finding some extra. In investing, loss aversion is a killer. It's what makes a 20% market drop feel like an existential threat. Now consider this. A lack of trust in the management of the companies you own acts as a powerful amplifier for loss aversion. Imagine you own a stock and it falls by 20%. If you have absolute, unshakable trust in the management team, if you believe they are brilliant, honest, and shareholder-oriented, your reaction is likely to be calm. You might even see it as a buying opportunity, a chance to acquire more of a great business at a discount. Your thought process is, the market is being irrational. I trust these people to navigate this downturn and come out stronger. But what if you have a small, nagging seed of doubt? What if you secretly worry the CEO is a bit of a promoter? What if you're not entirely sure about their capital allocation skills? Now that same 20% drop feels completely different. It feels like a confirmation of your deepest fears. Your thought process becomes, I knew it. This is it. The story is falling apart. I have to get out before it goes to zero. The doubt amplifies the pain of the loss, triggering a fight-or-flight response. Your rational, analytical brain, the prefrontal cortex, is hijacked by your emotional, fear-driven brain, the amygdala. You sell, not because of a reasoned analysis, but because of an overwhelming emotional need to make the pain stop. This is how portfolios are destroyed. The antidote is to build your portfolio on a foundation of trust so strong that it can withstand the emotional storm of a market panic. This requires a proactive mental model, a tool to stress test your conviction before you ever invest a dollar. I call this blueprint the pre-mortem for trust. It's an inversion of the usual pre-mortem exercise. Here's how it works. Before you buy a single share of a company, you perform a thought experiment. Imagine it is 5 years in the future, and your investment in this company has been a complete and utter disaster. Your thesis was wrong, and you've lost a significant amount of money. Now write the story of asterisk how it happened. Crucially, you must focus specifically on how the management team betrayed your trust. Don't just say, the economy turned bad. Be specific. Did the CEO make a foolish, ego-driven acquisition that destroyed the balance sheet? Did you discover they were using accounting gimmicks to inflate their earnings? Did they dilute shareholders by issuing a ton of stock options to themselves while the business was struggling? Did they fail to adapt to a changing industry landscape because they were arrogant and complacent? By forcing yourself to articulate the precise ways in which the management could fail you, you achieve two critical things. First, you identify the most significant trust-related risks for this specific investment. This moves them from the realm of vague anxiety to concrete, analyzable problems. Second, you can now research the management team's history with these specific risks in mind. Has this CEO made a questionable acquisition in the past? Is their compensation structure designed to encourage short-term thinking? Does the company have a history of being less than transparent in its financial reporting? This pre-mortem for trust either exposes a fatal flaw that warns you away from the investment entirely, or it dramatically strengthens your conviction. If, after imagining all the ways the team could betray you, You conclude that their character and track record make those scenarios highly unlikely. You have built a powerful psychological bulwark against future panic. You have preemptively addressed your own doubts. Now let's examine the antithesis, the path of the 99% of market participants. They don't engage in this kind of deep, trust-based analysis. Instead, they are renting stocks, not owning businesses. For them, a stock is not a fractional ownership of a real enterprise run by real people. It is a ticker symbol, a blip on a screen, an abstract financial instrument to be traded. They buy because of a hot tip, a good story in the news, or simply because the price has been going up. Their connection to the company is superficial and fragile. Let's follow the emotional journey of one of these renters during a market crash. The market begins to fall. At first, there is denial. It's just a healthy correction. As the losses mount, denial turns to anxiety. They start checking their portfolio multiple times a day. They become glued to financial news, searching for an explanation, for some reassurance. But the headlines are filled with words like plunge, crisis, and meltdown. The anxiety deepens into fear. Every downtick on the screen is a stab of pain. They start to catastrophize, imagining their life savings disappearing. Finally, the fear becomes unbearable. They reach a point of capitulation. They sell everything, just to make the pain stop. The feeling is one of relief, the kind of relief you feel after escaping a dangerous situation. But that relief is short-lived. Soon, the market bottoms and begins its slow, inexorable recovery. But they are on the sidelines, in cash, too terrified to get back in. They watch as the market climbs higher and higher, their catastrophic mistake now glaringly obvious. They have violated the cardinal rule of investing. They bought high and sold low. This entire destructive emotional cycle is the direct and inevitable consequence of an investment strategy built on sand. Because they had no deep trust in the businesses they owned, they had no psychological anchor to hold them steady in the storm. The direct financial connection here is profound and devastating. Let's quantify the impact. Consider two investors, both starting with a $100,000 portfolio. Investor A uses the pre-mortem for trust and builds a portfolio of companies whose management she deeply believes in. Investor B assembles a collection of popular story stocks she knows little about. A bear market hits, and the market falls 30%. Investor A's portfolio also falls to $70,000. It's unpleasant, but she has done her homework. She trusts her management teams. She remembers her pre-mortem exercise and feels confident they will navigate the crisis. She does nothing, or perhaps even adds a little more capital if she can. Investor B's portfolio also falls to $70,000, but for her, it is terrifying. She has no foundation of trust to fall back on. She succumbs to the psychology of doubt and sells her entire portfolio at the $70,000 mark, locking in a $30,000 loss. Now, the market recovers. Over the next 2 years, it rises 50% from the bottom. Investor A's portfolio, which fell to $70,000, now rises to $105,000. She is whole again, and then some. Investor B, who sold at $70,000, eventually works up the courage to get back in after the market has already recovered significantly. She misses the majority of the rebound. Even if she reinvests her $70,000 and captures some of the later gains, she is now permanently behind. Her $30,000 loss, compounded by the missed recovery, has put her on a much lower long-term wealth trajectory. Extrapolate this over a 30-year investing career with several market cycles. The difference in outcomes is not just a few percentage points. It's the difference between achieving financial freedom and a lifetime of struggle. The ability to hold on during a panic, an ability that is rooted entirely in trust, is the single greatest determinant of an investor's long-term success. It is the invisible psychological asset that pays the largest dividends of all. We have established the internal logic of Berkshire's trust-based system, we have learned how to identify trustworthy management, and we have confronted the psychological demons that a lack of trust unleashes. Now we arrive at the most practical and crucial phase, the application. How do you, as an individual investor, Systematically forge a portfolio of these sleep-well-at-night stocks. How do you translate the abstract principle of absolute trust into a concrete, repeatable process for asset allocation? This is about creating a portfolio that doesn't just perform well on paper, but also provides genuine financial peace. The foundational story for this pillar is Warren Buffett's investment in the Washington Post Company and, more specifically, his profound relationship with its leader, Katharine K. Graham. In the early 1970s, the stock market was in a funk, and newspaper stocks were particularly out of favor. But Buffett saw immense, untapped value in the Washington Post. It was a dominant newspaper in a major city, it owned other media properties, and it was trading for a fraction of what Buffett believed its assets were worth. But the key to the investment, the element that made it a true buy-and-forget holding for him, was his assessment of K. Graham. Graham had been unexpectedly thrust into the role of CEO after the tragic death of her husband. She was navigating a male-dominated industry and had overseen the newspaper's courageous, high-stakes reporting on the Pentagon Papers and the Watergate scandal. Buffett saw in her not just competence but immense courage, unwavering integrity, and a deep, multi-generational commitment to the quality and reputation of the Post. He saw an owner, not just a manager. In 1973, he began buying shares aggressively, quickly becoming the company's largest outside shareholder. He then did something that reveals the depth of his approach. He didn't just sit back and watch his investment, he sought a relationship. He began writing to Graham, offering advice and support. She, in turn, invited him to join the board of directors. For the next decade, Buffett served as a board member, a mentor, and a close friend to Graham. He advised her on capital allocation, on dealing with Wall Street, and on business strategy. He taught her to think of the company's shares not as a fluctuating stock price, but as a piece of the underlying business. He helped her implement a share buyback program when the stock was cheap, a move that massively increased long-term shareholder value. This story is crucial because it shows that for Buffett, investing based on trust is not a passive, box-ticking exercise. It's a deep, personal commitment. He wasn't just buying a stock, he was partnering with K. Graham and her family. He believed in her so completely that he was willing to invest not just his capital, but his own time and reputation to help her succeed. The underlying psychological principle at work here is the commitment and consistency bias. This is one of the most powerful forces governing human behavior. As psychologist Robert Cialdini has shown, once we make a choice or take a stand, especially if we do it publicly, we feel a strong internal and external pressure to behave consistently with that commitment. We will go to great lengths to avoid the cognitive dissonance of contradicting our past selves. Most investors are victims of this bias. They make a hasty investment, and then, as negative information comes to light, they engage in mental gymnastics to justify their initial decision, holding on to a losing stock far too long. But we can harness this bias to work to car us. By framing your investment decision not as a casual buy, but as a deliberate, well-researched partnership with a management team you admire, you are making a powerful commitment. You are stating, I have studied this leadership team, I believe in their integrity and skill, and I am entrusting my capital to them for the long term. This act of conscious commitment fundamentally changes your relationship with the investment. When a market downturn comes, selling feels different. It's not just closing a position. It's betraying a partner. It's breaking your own stated commitment. This creates a powerful psychological friction that makes it much harder to panic sell. You have recruited the consistency bias to serve as your ally, to enforce the discipline required for a true buy-and-hold portfolio strategy. Now let's build the practical blueprint for making this commitment. This is the 10-year Guardian test, the ultimate filter from our opening thought experiment. To determine if a management team and their company can be a true long-term holding, you must answer a specific set of questions with a resounding yes. There are 5 key areas to investigate. Number 1. The track record of competence. Trust must be earned. Look back at the last decade. Has this management team successfully navigated a recession or a major industry disruption before? Don't just look at what they did in the good times. Anyone can look like a genius in a bull market. Examine their performance during a crisis. Did they make smart defensive moves? Did they treat their employees and customers fairly? A proven ability to handle adversity is a crucial sign of a team you can trust when the next storm hits. Number 2. The history of rational capital allocation. This is the acid test of a shareholder-friendly mindset. Obtain the company's annual reports for the last 10 years. Create a simple log of their major capital allocation decisions. When did they buy back stock? Was it when the stock was objectively cheap? Or did they buy it back at market peaks just to prop up the price? What acquisitions did they make? Go back and read the press releases from when the deals were announced. How did the CEO justify the purchase? And what were the results? Was the acquisition successfully integrated, and did it add value? A clear pattern of rational, value-enhancing decisions is the clearest signal of management quality. Number 3. The standard of communication. Apply the shareholder letter skin we discussed earlier, but do it across a decade. Is there a consistent pattern of candor, clarity, and honesty? Do they use the same metrics to report their performance year after year? A long history of transparent communication builds a reservoir of trust that you can draw upon during periods of uncertainty. Number 4. The alignment of incentives. You must investigate the company's proxy statement. This document details how the top executives are paid. This is not about how much they are paid, but times how. Is their bonus tied to metrics that build long-term value, like growth and return on invested capital, or per-share intrinsic value? Or is it tied to short-term, easily manipulated metrics like adjusted earnings or the stock price on a specific date? You want to see compensation plans that incentivize managers to think and act like long-term owners. Huge grants of stock options that massively dilute existing shareholders are a major red flag. Number 5. Significant skin in the game. Do the CEO and other top executives have a substantial portion of their own personal net worth invested in the company's stock? Look for evidence of open market purchases, where they are using their own cash to buy shares, not just receiving them as grants. When a manager's financial well-being is directly and meaningfully tied to the long-term success of the company, their interests are naturally aligned with yours. There is no stronger guarantee of a shareholder-friendly approach. If a company's management passes all 5 of these rigorous tests, you have found a potential candidate for your sleep well at night portfolio. You have found a team that has earned the right to be your 10-year guardian. The antithesis of this disciplined approach is what I call the growth at any price trap. This is the path taken by investors who become infatuated with a compelling story, particularly in fast-moving technology or biotech sectors. They hear about a visionary CEO with a revolutionary product that is going to change the world. They see the stock price soaring and are gripped by the fear of missing out. They throw all diligence out the window. They don't check the track record, because there often isn't one. They don't analyze capital allocation, because the company is likely burning cash, not generating it. They don't scrutinize the communication, because they are captivated by the visionary promises, not the sober realities. They completely ignore incentives and skin in the game. They are buying a lottery ticket, not a piece of a business. The dot-com bubble of the late 1990s was the ultimate manifestation of this trap. Investors poured billions into companies with no revenue, no profits, and no viable business model, all based on a story about the new economy. They entrusted their capital to management teams that were often young, inexperienced, and in some cases, outright fraudulent. When the bubble burst, fortunes were wiped out, not because the internet wasn't a transformative technology, it was, but because investors had abandoned the fundamental principle of trusting proven management. They bought the hype, not the people. The direct financial connection between these two approaches can be seen by modeling the long-term outcomes of two distinct asset allocation strategies. Portfolio A is constructed using the rigorous 10-year Guardian test. This process is time-consuming and demanding, so the resulting portfolio is likely to be concentrated, consisting of perhaps 10 to 15 companies that the investor understands deeply and whose management they trust implicitly. This is a portfolio built for financial peace. Portfolio B is assembled by chasing stories and following the growth at any price trap. It's likely to be a scattered collection of 50 or more stocks, many of which the investor doesn't truly understand. It's a portfolio built on hope and FOMO. Over a 20-year period, the financial performance of these two portfolios will diverge dramatically. Portfolio B will be incredibly volatile. Some of its holdings will flame out and go to zero. A few might deliver spectacular gains, but the overall result is often a chaotic, anxiety-inducing ride that ends in mediocrity. The investor is constantly reacting to news, trading in and out of positions, and second-guessing their decisions. Portfolio A, the sleep well at night portfolio, will behave differently. Its volatility will likely be lower. The companies within it, run by rational, shareholder-friendly managers, will be more resilient during recessions. They're more likely to pay growing dividends and to intelligently buy back their own shares, creating a dual engine of returns. The investor, having built their portfolio on a foundation of trust, is able to ignore the market's manic swings. They hold on, letting their carefully chosen partners compound their capital year after year. The final result for Portfolio A is not just superior risk-adjusted returns. It's a profound sense of control and calm. It is the tangible financial reward for having the discipline to invest only with people you can trust as much as family. It is the very definition of a successful long-term investing strategy. We have now come to the final and perhaps most profound pillar of this philosophy. We've seen how trust forms the operational blueprint of Berkshire Hathaway, how it serves as a litmus test for stock picking, how its absence unleashes psychological demons, and how its presence allows us to forge a resilient, sleep-well-at-night portfolio. Now we must connect it all to the ultimate outcome. We must understand how the intangible moral quality of integrity creates tangible, calculable, and ultimately incalculable financial value over the long run. This is the principle of the compounding of character. There is no greater illustration of this than Warren Buffett's role in the Salomon Brothers scandal of 1991. At the time, Berkshire Hathaway was Salomon's largest shareholder, with a $700 million preferred stock investment. Salomon was one of the most powerful and aggressive investment banks on Wall Street, known for its take-no-prisoners culture. In August of 1991, a bombshell dropped. It was revealed that a rogue trader at Salomon had been submitting false bids in U.S. Treasury auctions to corner the market, a flagrant violation of federal law. Even worse, the top leadership of the firm, including its CEO John Gutfreund, had known about the misconduct for months and had failed to report it to the authorities. The scandal exploded. The U.S. Treasury banned Salomon from bidding in its auctions, a move that was effectively a death sentence for the firm. Its clients fled, its credit was cut off, and the company was on the verge of a catastrophic bankruptcy within days. Buffett's $700 million investment was about to evaporate. In this moment of extreme crisis, the U.S. Treasury Secretary called Buffett and essentially begged him to step in and take control of the firm to prevent a systemic collapse. At great personal risk, Buffett agreed. He flew to New York and was appointed interim CEO of Salomon Brothers. The first thing he did was not to pore over the balance sheets or trading logs. His first priority was to address the firm's shattered integrity. He understood that the financial problem was merely a symptom of a deeper cultural disease. In his very first address to Salomon's thousands of shell-shocked employees, he laid out his new philosophy with bracing clarity. He said, "Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless." This single sentence was a revolution on Wall Street. It inverted the industry's long-standing ethos of profits at any cost. Buffett's message was clear. Integrity is not a nice-to-have. It is our single most important asset. Without it, we are nothing. He then went before the United States Congress to testify. He was candid, humble, and deeply apologetic. He promised to clean house, to cooperate fully with investigators, and to install a new, permanent system of controls and ethics. His performance was a masterclass in crisis management, built entirely on the principle of radical transparency and a commitment to restoring trust. His actions saved Salomon Brothers. The Treasury reinstated its bidding rights, clients slowly returned, and the firm survived. Buffett's actions not only protected his investment, but also reinforced his own global reputation as a figure of unimpeachable integrity. The psychological mechanism that makes this story so powerful is the halo effect. The halo effect is a cognitive bias where our overall impression of a person or a company influences our feelings and thoughts about their specific traits. If we perceive a company as having high integrity, we are more likely to believe its products are high quality, its financial statements are accurate, and its employees are trustworthy. A strong reputation for integrity creates a positive halo that illuminates the entire enterprise. This halo creates what Buffett would call a moat of trust around the business. This moat has tangible economic benefits. The most talented and ethical people want to come and work for you. Customers feel more confident doing business with you, even if your prices are slightly higher. Regulators are more likely to give you the benefit of the doubt during a dispute. In a crisis, like the Tylenol poisoning incident for Johnson & Johnson, a deep reservoir of public trust allows you to navigate the storm and emerge with your reputation and your business intact. Conversely, a single act of dishonesty can trigger a negative cascade, a Horn's effect, that can destroy decades of value in an instant. Think of companies like Enron or Volkswagen after its emissions scandal. The discovery of their deception shattered the trust they had built, leading to financial ruin and a permanent stain on their brand. Integrity is not just a moral asset, it's a powerful competitive advantage that is incredibly difficult for rivals to replicate. To apply this in your own investment analysis, you can use a mental model called the reputation ledger. For any company you are considering as a long-term investment, create a mental ledger with 2 columns, trust deposits and trust withdrawals. A trust deposit is any action the company takes that builds its reputation and strengthens its halo of integrity. This could be a decision to transparently recall a faulty product, even at great short-term cost. It could be a commitment to treating employees exceptionally well during a difficult economic downturn. It could be a history of walking away from deals rather than overpaying. A trust withdrawal is any action that erodes reputation. This could be a minor accounting restatement, a lawsuit for deceptive marketing practices, or a pattern of executive turnover that suggests a poor corporate culture. Over time, you should be able to see a clear pattern. Is this company's management team consistently making deposits into its reputation account? Or are they slowly bleeding it dry with a series of small, ethically questionable withdrawals? A company with a long history of making trust deposits is building a durable asset that will pay dividends for decades. A company with a pattern of withdrawals is sitting on a hidden liability that could explode at any moment. This brings us to the final antithesis, the flawed intellectual foundation of the efficient market fallacy. The efficient market hypothesis, in its strong form, is an academic theory which posits that all public and private information about a company is already reflected in its current stock price. Therefore, it's impossible to consistently outperform the market through analysis. A strict believer in this theory would argue that soft factors like management quality, corporate culture, and CEO integrity are irrelevant because their financial impact is already priced in. This is a catastrophic mistake. It's the kind of thinking that leads to a purely quantitative, checklist-based approach to investing that completely misses the forest for the trees. The story of every great business failure, from Enron to Wells Fargo during its account fraud scandal, is a story about a deficit of character that was invisible if you only looked at the reported numbers. At Enron, the earnings per share looked fantastic, right up until the moment the company was revealed to be a complete fraud. At Wells Fargo, the cross-selling metrics were the envy of the industry, until it was discovered they were being achieved through millions of fake accounts created by employees under immense pressure from management. In both cases, The efficient market was utterly blind to the ticking time bomb of a corrupt corporate culture. The numbers lied. The character, or lack thereof, told the truth. Investors who had done their due diligence, who had applied the reputation ledger and found a long series of trust withdrawals, would have stayed far away, regardless of what the spreadsheets said. The direct financial connection, the ultimate proof of this entire philosophy, can be seen by looking at the long-term stock charts of companies with different reputational histories. Find a company in any given industry that is legendary for its shareholder-friendly culture and its unwavering integrity. Chart its stock price over the last 30 or 40 years. What you will likely see is a smooth, beautiful, upward-sloping line of compounding wealth. The business may have faced recessions, competition, and crises, but its foundation of trust allowed it to endure and prosper. Now, find a direct competitor from the same industry that has been plagued by ethical lapses, short-term thinking, and a poor reputation. Chart its stock price over the same period. What you will likely see is a chaotic, volatile mess, punctuated by catastrophic drops from which it never fully recovers. It is the long-term stock chart of a business at war with itself and its customers. The difference between those two charts is the final, undeniable proof. It is the multi-billion-dollar quantification of character. The compounding of character is the most powerful force in long-term investing. It is the invisible engine that drives the returns of the world's greatest businesses. When you find a business with a durable competitive advantage, run by a management team with a long and proven history of integrity, you have found the Holy Grail. You have found a business that will not only grow, but will do so with a margin of safety that a focus on numbers alone can never provide. You have found the final key to letting your wealth compound in peace, secured not just by assets and earnings, but by the most valuable and enduring asset of all, a reputation that has been earned. You have just spent this time acquiring a powerful new lens through which to view the world of investing. You have moved beyond the noise of the market and connected with a deeper, more enduring principle. You now possess the framework Warren Buffett has used for over half a century. The understanding that absolute trust is not a qualitative preference, but the ultimate quantitative advantage. You understand that a portfolio built on this foundation is not just more profitable, but a source of genuine financial peace. But what you've mastered today is a single crucial pillar in a much larger architecture. Buffett's system of thought is not a collection of isolated tips. It is a network of interconnected mental models, each one strengthening and informing the others. The trust filter you've just built is the final gateway, but to truly secure your financial future, you must understand the models that lead you to that gate. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in your journey. It holds another piece of this intricate map, another model from this powerful mental arsenal. It contains the link that connects the who of management to the what of business quality, the vital connection that allows this entire system to function. Many will stop here, satisfied with the knowledge they've gained. They will possess one powerful tool, but they will not have the complete toolkit. But for those of you who are serious about this journey, for those who see this not as entertainment but as education, the next step is clear. The choice to click is not about watching another video. It is a declaration of your intent to continue your ascent, to complete your understanding, and to build an unshakable foundation for your wealth. The choice is yours. Complete the map,